Good afternoon, and thank you for joining us for today's roundtable on mitigating risk in cross-border deals. I'm Ben Collins with Intralinks, and I will be moderating today's discussion as we explore the following topics. What geographic regions will be the ones to watch over the course of the next few years? What can we expect for tax inversion deals going forward? And what lessons have we learned about executing deals in China? Joining us today are Greg Sias, Corporate VP of M&A at Applied Materials, Steven Selhausen, SVP of Corporate Development and Strategy at Dover Corporation, and Glenn Fogel, Head of Worldwide Strategy and Planning at the Priceline Group. We've got a lot to cover today, so let's get started. Glenn, I'd like to start with you. I know you've faced some regulatory concerns and issues recently in some of the deals that you've been looking at on a cross-border basis. Would you mind just sharing with us and elaborating a bit on some of the regulatory pieces that you've been encountering recently?
Sure. And I like to look back not at something that's recent, but it's so important showing how dangerous the regulatory environment can be if you're not careful. And it's a deal we looked at many, many years ago. You know, Priceline Group, we're in the travel business, and a lot of people who aren't U.S. citizens like to go to Cuba. So anytime we've looked at any sort of travel company outside the U.S. that we're going to buy, we have to be very careful. Are they doing any business in Cuba? And if so, they have to stop. Even if they're a foreign-owned subsidiary, U.S. law, they cannot do that. The company we're looking at very carefully and getting pretty far along, spending money with lawyers, et cetera, get along. And all of a sudden it occurred to me, I spoke to the opposing counsel and I said, gee, is there anything else we need to know? And he says, well, you really should talk to your own counsel about that, which just pricked up my ears. And it turned out we learned that that country had passed a law that prohibited any U.S. company from stopping any company that's domiciled in that company from stopping doing business with Cuba. So the issue was, if we had bought that company, we couldn't have stopped it without breaking the law in that country. And if we didn't stop it, we'd be breaking the law in the U.S. And we came very close without realizing that there was such a law. So in that environment, it could have been a complete disaster. So the only thing I can always say, and I say this to my team all the time, is, you know, there are a lot of things that we don't know what we don't know. So it's something that can be very problematic.
Yeah, interesting. Sounds like almost a lose-lose situation that you were potentially embarking upon there. So Steve, want to get your insights here as well. Regulatory issues that you've seen recently, any changes that have impacted the way you look at cross-border deals?
You know, there are a number of issues that we've confronted on a cross-border deal. You know, always antitrust is one of the concerns. You have to make sure you're complying with all the different regimes, whether it's the EU. There's actually a lot of countries out there where you have to file. They just use it as a revenue generation mechanism, you know, esoteric Eastern European countries that are kind of interesting. Nobody really knows why you have to file there. So, you know, the typical antitrust filing, there is employee secrecy laws within Europe that are much more strict than the U.S. You have to be careful that you comply with those. When you get over to Asia, we're going to talk about China a little bit more later here, but there's pretty complicated business license transfer rules. So those are a lot of things that just make it a little more challenging. You know, good local counsel. You know, I take your comment. You have to really have the right advisors and make sure they're complying. And ironically, we ran across that similar situation, ran into a country where we could not prohibit ourselves from doing business with other countries. So we ran into that situation also.
Yeah, and Greg, how have you and Applied Materials navigated the regulatory path, and any specifics related to your industry, or echo some of the comments and observations that others have made so far?
Yeah, I think when we think about the regulatory climate and how that's changed in the recent past, one of the things that we would point out would be definitely that the DOJ and the FTC in the U.S. have shifted their view away from market definition recently and more, you know, more of a focus on the HHI calculation to one of the lack of competitiveness and impacting competitiveness. And so that clearly has been the change both in the United States, and I think we're seeing that elsewhere as well. And when you talk about impacting competitiveness, primarily they're talking about the number of remaining competitors. And so, you know, 5 to 4 transactions in terms of the number of remaining competitors after a merger are probably acceptable. 4 to 3 is on the edge. 3 to 2 is where typically you see trouble in any given space. I think the other point with respect to regulatory bodies is the emergence of China, as Steve brought up, and so, China has come a long way in the last, 5 to 10 years on the subject matter, and really has become one of the key regulatory bodies in conjunction with the U.S. DOJ and FTC, as well as the European Commission, and I believe as well they've signed some cooperation agreements, and so really they are they are one of the key bodies that we deal with on our transactions.
Yeah, interesting. So Glenn, back to you. You were nodding along with some of the metrics that Greg was citing there. Are those fairly consistent with what you've seen in the past?
Well, it depends on the industry, et cetera. We don't, we try very carefully to understand what's the environment before we enter into a deal, and antitrust is always critical, and are we going to have an issue or not? But I have to totally agree with Greg in the sense that you have a lot of different regulators who are looking at things a little bit differently than the other one. So you may fit fine with one, you don't fit with the other, but don't forget, you have to win them all. Yeah. Just one loss and you lose. Right. So it's something that is unfortunate, but he's got a point. I mean, China now is a regular. We never had to worry about that 10 years ago. Now you have to look at the analysis in the same way you would with any other jurisdiction, and it creates a lot more expense, a lot more time, and a lot more concern, particularly because it's new. So you're not sure exactly when it's a new regulatory environment. How do they usually treat things? How do they look at it? And so we don't have a lot of past practices to go by.
Yeah, interesting. And Steve, I know we've brought up China, and we'll explore that in a bit more detail later on in the conversation. But one of the things that I know you've encountered recently is some anti-privacy or employee privacy regulations within the EU that have been a diligence hurdle of sorts. And maybe you could just spend a minute explaining some of the ways you've managed to mitigate that.
Right. Yeah. So we've made a number of European acquisitions, and given the cost of doing business in Europe generally, there's a generally higher cost of labor, workers' unions, workers' councils. You might imagine there's a lot of our focus is on competitiveness from the labor side. So you want to do a lot of due diligence around employees, their salaries, their benefits, and you pretty quickly run into some of the pretty strict European employee privacy rules. Where, best case, you probably can have your lawyer see some generic data on, demographics, age, salary levels, things like that. So we found that it has actually been an issue as far as really understanding what you're buying, the workforce composition, and like most strategic buyers, we buy businesses and we're looking to generate synergies. One of the areas is, can we combine businesses, homogenize things like benefits, things like that. And if you really can't get access to the data, it makes it a little bit more challenging. And the EU has been very different in terms of U.S. on employee privacy. So it's been a challenge for us. You're generally able to work around it, but you never quite get the level of detail in the EU you might, say in the U.S. or elsewhere, for example.
Has that been your experience as well, Greg, in the EU specifically?
Yeah, I think, for us, we haven't, knock on wood, we haven't had any specific EU level filings. We've filed in individual member states, but not had to have an EU level filing. But so, we have had some experience with the European Union.
Great. What about FCPA? Top of mind for anyone and everyone looking at a cross-border transaction. Managing risk on that front is paramount. I mean, talk about a game where you can't just lose one set. How do you manage that, Steve? I want to start with you.
Sure.
I mean, it's clearly a tricky road.
Right. Depending on the country you're going into, there are certain countries where the business practices, there are various forms of business practices that are not acceptable in the United States or are illegal for that matter. So there's the whole gamut of business practices. We start with extensive due diligence. We hire local advisors, but we kind of come at it from the perspective we're never going to completely understand everything that's going on within a business, say China or Brazil or some other countries, Russia, for example, where the business climate is a little bit more challenging. The second thing we do is we try to do as much due diligence as possible. What's important for us as a large U.S. public company is to say, we will have our own compliance processes in place. There may have been some past practices with organizations that we may ultimately acquire. They probably have business practices. We make sure that whatever has happened does not present a liability for us. And then, we effectively clean them up. You're always going to miss something, but I think the defense, if you ever, do get accused of buying a business where there was bad practices, is listen, we've done as much due diligence and process. We have our own compliance procedures. We've put those in place. And, in a sense, you do the best you can, and you just have to go in it with your eyes wide open, understanding that business practices. Ironically, from a commercial standpoint, FCPA to us has almost become, there's a legal aspect to it. When you change the business practices of a company in a place like China or Brazil, you're going to have a revenue drop immediately because the salesmen can't practice the way they've been selling to their customers for years and years. So we will actually go into a deal and say 25, 30% of revenues we think is just going to go away day one because we have to change the way these guys do business. So from there's a legal aspect to that, but there's an actual economic impact, commercial aspect to FCPA that is very difficult to quantify.
Yeah, you bring up a few interesting things here, Steve, and I want to get the group's input on. So I just want to elaborate on trusting the process itself, in that there are going to be things that maybe slip through the cracks, but what does the process look like? How have you defined it? What have you learned?
Yeah, I think, just like Dover, we've spent an awful lot of time thinking about how to build FCPA into our diligence process over the last several years. It really is a bribery and anti-corruption risk assessment, if nothing else. And we have to, we feel like we get more out of interviews than we do out of looking at documents in particular. It really is about trying to understand, what are the distribution channels, where are the contacts with governments, where are the entities that they have that are particularly focused on cash and particularly cash rich. So it takes an awful lot of kind of time on the ground, face-to-face interviews, and building it into your process. And I know for us, I think we've added 4 pages to our diligence checklist related to FCPA assessment in the context of a diligence review. So a big focus for us.
Yeah, I agree with everything that's said. And I'd add in, one of the great things about doing deals over a long period of time is really getting to know the management and the way they roll and what kind of attitude, what's the culture like. And that can make a huge difference right from the get-go, because you really have to trust your gut. And you're never going to know everything. And if someone's a bad egg, it's a bad egg. But you certainly can get at least a sense of what does the person want. Is he a straight, narrow guy? Does he shoot straight or not? And I'll tell you, there was something there right away in a country that is a high-risk country, let's call it. And I had a meeting with the CEO and the CEO of one of our subsidiaries too. We were having a lunch meal. And I asking, this is a very early stage type discussion. And he says, tell me, taxes, how's that going on and everything? He says, oh, no problem, I'm very friendly with the tax guy. And alone we'll say, okay, check please, I think we're done. And that was it. And you have to trust your gut. If you don't trust the very senior guys, well, there's that old saying about, things that they stink from the head.
Right. It's interesting when you talk about the talent, we like to try, so we generally buy private companies. We love to find that company where he's an entrepreneur, but maybe he was Western educated, or he had done a stint in a, not a US, but a more multinational organization where he may have been exposed to FCPA or compliance issues, where at least it gives you a leg up. It's not like you're talking to him for the first time and you're saying, well, here's the US laws or the UK anti-bribery laws, and he's nodding his head, but you don't really know whether he is fully aware or understands that. If they generally, or the top management team is at least sprinkled with some either Western educated or somebody who's worked at a larger global European or US company, he generally will have been exposed to it and at least have a greater understanding, appreciation for where we're coming from on it.
Yeah, I think someone pointed it out earlier, but you really want to make sure that you have a strong and robust diligence review around FCPA to make sure that if you do get a review by the DOJ or the SEC on this kind of a thing, you have something that you can stand on and say, this is the analysis that we did.
Because you're never going to get it all.
You're never going to get it all. And I looked up, recently, what have been the number of enforcement actions, and recently the number that I found was 75 back in 2010, and with settlements of 1.8 billion, and GE was 24 million of that. Mm-hmm. And so I think, as Steve said earlier, you definitely don't want an enforcement action. This is the kind of thing that really erodes investor confidence in the company. So that's a really, really important issue.
Good. So let's shift gears for a minute here. Greg, why don't you talk about tax inversion? So this is something that has been in the headlines recently. It's been making some news, and I know you've got some experience that maybe you can share with us, and we can take the conversation from there.
We do, and just I get a couple of lead-off comments on that. We have a announced inversion right now with the transaction with Tokyo Electron, and a handful of things that I would say is, number one, inversions in and of themselves are not new, and they're not news. Companies have re-domiciled for many, many years and decades, as well as companies have sought lower tax rates through offshore structures, right? And so that kind of activity has been happening for years. The lower tax rates through offshore structures have really built up the amount of offshore cash, trapped cash, that I think has been roughly 1 trillion at the end of 2013, is probably closer to 2 trillion now. Mm-hmm. Now, re-domiciling does mean that your headquarters and location will be outside the United States, right? And for all intents and purposes, you're a non-U.S. corporation. And quite frankly, you can get, in terms of cash tax savings, you can get a significant amount of cash tax savings without re-domiciling through an offshore tax structure. The problem is repatriation of earnings. I think, the long and the short of, and there has been recently a lot of backlash in the government. I think Senator Schumer has a bill, Senator Levin has a bill. And the fact of the matter is, we didn't announce our planned merger on the basis of a tax strategy. And I don't know, that many companies would do that. We announced our merger because it's made strategic sense. And we felt very comfortable with working with Tokyo Electron and the rest of the business strategy that surrounds that transaction. And the other thing that I would tell you is, not everyone can do a corporate inversion. You have to have more than 20% foreign ownership mm-hmm. of the equity of the company to do it. In the end, I think we as employees and management and corporate boards have a fiduciary duty to shareholders, and doing that fiduciary duty means being competitive globally. And one of the reasons to pursue a tax strategy like that is to be more competitive. And in the end analysis, what it does is it brings more after-tax cash dollars back to the United States. Potentially, you can hire more employees, potentially put more money back into the U.S. economy, and so, that broadly is our view, and I think, there's generally a need for broader U.S. corporate tax reform.
Interesting. So, Steve, you want to?
Sure. It's a hot button topic right now. I think I completely echo a couple of the comments. The current tax regime for a U.S. taxpayer is such that, as you said, a lot of stranded foreign cash that we can't bring back tax efficiently, and we have a high effective corporate tax rate, 35% relative to a lot of other countries. That structurally creates a lot of cash offshore and creates tax planning that's been going on for decades. This is not anything new. An inversion, in my mind, is nothing more than a merger with a foreign company. A lot of people merge with foreign companies. That's been going on for a long period of time. So strategy should drive what's going on, specifically something as complex and potentially value creation or destroying as M&A. You're going to do a cross-border deal. Boy, all I can say is the strategy, as you've pointed out, that's really what's dictating things here. From that point on, every deal I've ever been involved in through my career, whether it's an inversion or other, you're going to look at creative ways legally within the tax regimes that you're doing the deal in to optimize the value. That's your fiduciary duty as an executive of the company to do that. So, this is just kind of the latest version. It's getting a lot of political press, or a lot of press around it. But I think that's what we're supposed to be doing strategic deals if it's cross-border and it's with a foreign company, and we're supposed to be maximizing the value for our shareholders. Mm-hmm. And so that's kind of the way we look at it. I can't speak for other people, but I would be surprised if somebody's doing an inversion strictly for tax purposes. It's really, in my mind, largely a strategic discussion.
Right.
Yeah. It's interesting about this because if you look back 80 years ago, there was the Supreme Court case, and Justice Learned Hand, in his opinion, he talked about that there's no obligation to pay more taxes than you're legally obligated to. And he even says it's not even your patriotic duty to pay more. And now we hear politicians talking about, well, it is your patriotic duty to pay more than you have to pay, which is interesting. The next thing that I find is today they're voting in Nevada, in the legislature there, about whether or not to grant the $1.25 billion to bring Tesla's battery factory to Nevada. Competitive, this is the whole Adam Smith, this is the invisible hand, competition, making things better. So we are certainly all fine in the states who are trying to compete with each other, create the best business environment to bring that business, create those jobs. Yet we're not willing to compete outside the U.S., where it's just pointed out by Steve, a lot of the other countries have tax rates that are significantly lower for a corporate rate than the U.S. That's a disadvantage. And I sometimes just fantasize, could you imagine what this will be like if we had no corporate tax at all? And we'll get the money somewhere else, maybe get a higher personal rate or whatever. Of course, we put a lot of income tax lawyers out of business, corporate tax out of business, whole departments be destroyed. But the amount of the amount of effort you put into that, what a waste. But that's a fantasy.
Right, and hopefully not too many of those lawyers are listening today, because I think we just lost their attention.
They all signed off.
Yeah.
They're not worried.
Good, so let's shift gears here, guys, and talk a bit more about China. So it's again, something that gets a lot of ink in the press. A lot of people like us talk about it, and it's something I do want to just spend a few minutes discussing here today. So, Glenn, maybe you could just get us kicked off. I know that you've had some recent experience in China, looking at some deals and so forth. So, what unique challenges have you faced over there? And if you could just maybe spend a few minutes talking us through.
Yeah, we don't have the time to go through all the issues.
Right. Some of the observations. How about that?
Let's talk about something that right off the bat, and it's a cultural thing. Right off the bat, the U.S. is a great disadvantage because of our lack of language ability. Everybody I deal with in China, of course, is speaking English to me because I don't speak Chinese. In fact, there's a great shortage of high-level executives from the U.S. who speak Chinese. So right away, you're at a disadvantage. Understanding just the way business is done, what people consider to be important, what's not important. The concept of long-term, this is something that has come up all the time. I think long-term is a 5-year deal. They think long-term is a 99-year deal. There's a very different type of viewpoint sometimes. And just trying to get on the same page can be difficult. So right away, there's a big difference in doing a deal in China and doing a deal between a New Yorker and a Californian. I think go into the regulatory environment, in terms of what's allowed, what's not allowed there, even trying to understand what are the rules. Because don't forget, they're growing so rapidly and so many different things are coming out. We discussed a little bit of antitrust, that it wasn't an issue 10 years ago. Now it is an issue. There's so many things that you have to be careful about. Sometimes people say, well, I can't deal with China. It's too complicated. It's going to cost too much money. But you can't do that. It is the fastest growing large economy in the world. If you don't do it, particularly in my business, the travel business, you're going to be so far left behind. You have to deal with it and spend the money to learn.
Yeah, interesting. The cultural piece, Steve, have you encountered that as well? Where he was just Glenn was just referring to the difference in time frames, which I think is speaks to those different mentalities on each side of the deal table. Have you seen that?
Yeah, we've seen that a lot. The language barrier is a significant one. Their approach to business, their approach to intellectual property. There's the old cliche of the Chinese copy, and that's a terrible cliche. But their approach to business is that if it's kind of okay to something that's legal, copy it, and manufacture it more cheaply. So the idea of buying a business, and we negotiate and say, well, of course that person can't compete with you. I just gave him a bunch of money. He can't go across the street and start up a business. From their perspective, they're like, well, why can't I do that? It's more of a free-flowing capitalistic. So culturally, it's a much more open version of business practices, capitalism. Their views on intellectual property are much more open, shall we say, that if somebody's not going to stop you from doing it, they may just compete in ways. I think the other comment I wanted to make about China is your comment at the end about it's a big market for Europe in the travel industry. I think strategically it is very difficult to do deals in China, whether it's cultural, whether it's FCPA, whether it's legal, whether it's business practices, the language barriers. You really have to have a really compelling strategic reason why you want to be there. And I think people sometimes get enamored, well, China's a big market, growing middle class, their GDP is 7.5, whatever it is, 8%, and I've got to be there. If you kind of confuse yourself in saying, I have to be in China, but if you're not really clear of the strategic reasons, whether it's technological, low-cost products, access to their consumer bases, customers, you're going to go through a lot of pain, and your risk-adjusted returns, that hurdle rate should be pretty high. So really having a clear strategic reason why you have to be there, why you want to be there, and then recognizing that those returns better be pretty attractive because there is just a lot of risk and difficulty with doing business there.
And so, Greg, I think that you bring up an interesting point there, Steve, and Greg, I want you to touch upon it. So, this isn't a board game for world domination where we're looking to move our pieces around and claim territories. Obviously, there has to be that strategic rationale. How is that, how do you, in one sense, balance the attractiveness of this fairly untapped market in many respects with the pragmatic realism of getting a deal done and try and balance those two factors and when looking at a return?
Well, a couple of thoughts, on the basis of what Glenn and Steve said, that all of those comments are true. This is, doing transactions with the Chinese or in China this is really well-worn territory, right? And so it is slower process. Their views on intellectual property are different. Culturally, it is a different place to do business. Quite frankly, we deal with many of those same issues in other places and doing transactions in other places in Asia as well as sometimes in Europe. And so some of those issues aren't special to just China. For us, we encounter China, most often in selling businesses as opposed to on the buy side. The semiconductor business is not nearly as large in China as it is in other places in Asia. The solar business is much stronger in China. And so, we do encounter with Chinese buyers with many of our assets, many of the same issues that have been talked about here.
Okay. So just picking up on a few things that were talked about earlier. So license transfers in China. Steve, you had mentioned that as one particular regulatory piece, and it seems like you've got some experience. I don't know if it's good or bad. Maybe you could just spend a minute explaining your thoughts there.
It's not good or bad. It's just, to your point, it takes longer. There's so many layers of government, local government, regional government, national level government, that when you think you've signed a deal, you've signed the purchase contract, you're really not done. So in the United States, maybe it's conditional on antitrust approval as the only condition. In China, there is many more levels of actual, because we're a Western organization, we're maybe buying it through an Asian subsidiary. Transferring a business license to practice in China takes time. It goes through various levels. At the end of the day, we haven't found it an insurmountable hurdle. It just takes time. Interesting as an aside story, culturally, we tried to buy this very interesting and strategic business in a certain region of China, and the owner would not sell his business to us because he sat on the local government I don't know what regulatory body, and if he sold his business, he would have to resign that position. So an issue that you would have never imagined, an impediment to a guy selling his business, to a gentleman selling his business, because that position was more important to him, the local governmental position, than actually the value he could get out of his business. So, but back on your point, it's not an insurmountable hurdle. It's just an extra level. There's so many levels of government. You just have to deal with it. And you can't practice business in China as a foreign corporation unless you get that I forget what it's called, the CHOP. That's right. It's called the CHOP. That stamp. You're not good to go until you get that.
Yeah, interesting, Glenn. So the extended duration of getting these deals done, either as a buyer or a seller, and if you have experience on one side of the table versus the other, please share. But does that extra time that's built into the process help you in one sense, in that you do have a bit more of an ability to do the due diligence related to vetting the management team and figuring out if there are FCP hang-ups that need to be managed or scare you away?
Yeah, I mean, it's a two-edged sword, because if it's not a competitive situation, you have all the time in the world, that's lovely and great, isn't that wonderful? A lot of times it's not that. So if you're competing with somebody who can move much faster because they're local, well, now you got an issue now, because somebody else he doesn't have to worry about any sort of CPA. It's not his issue. Now, yeah, but you were concerned about that. So it works both ways. And I'm not sure whether I'd say in general whether I'd like to move faster or not. Maybe it's just the conservatism that I have in general. I like to go slower and be sure than to do the way some people are able to do deals right away and not worry too much about the risks. But no doubt, speed wins sometimes.
Good. So let's transition a bit here. So one of the things that I think is interesting is when we think of cross-border, we generally think of BRIC. We think of what's been called the next 11 in terms of emerging markets. But a lot of the energy and activity that is technically cross-border is looking at deals in the EU, Canada. There's a lot of I guess more classic M&A transactions that are cross-border that fall outside of that BRIC categorization. So maybe you could talk about how you still look at emerging markets, but also balance the need to be in some of the more conventional markets, for lack of a better term. Steve, could you
sure.
maybe get us kicked off?
Not to go back to the tax structuring issue, but remember, we're a U.S. corporate taxpayer, so for me, a cross-border deal is anything outside of the U.S. 50 states. So a Canadian deal to me is a cross-border deal.
Right.
So exactly to your point, because I can use foreign capital that I can't repatriate to make that investment, and that's excess capital. So cross-border is much more broadly defined than just the BRIC. The ones that we find interesting, we like buying European companies, and I comment on the difficulty with employee secrecy, but European companies, they've been doing business globally probably longer than most U.S. companies, number one. They have pretty well-established international service centers, networks, et cetera. So that's one way you can do a cross-border deal and pick up emerging economies. We're in the energy equipment business, so we like places where shale gas is being found. Argentina, Venezuela is kind of a mess politically, but there's a lot of oil and gas there. Mexico is very attractive to us. Russia has a lot of natural resources. Obviously, politically, it's pretty tricky right now. So some of those countries, Colombia is very interesting to us. So it's not just the BRIC. India to us is challenging. It's kind of where China was. Everybody sees it as this large, huge opportunity. But if possible, it's even more difficult to do business than in China. But we're spending time in India, and we're going to try and do some things there.
So Greg, I just want to pick up on that. So Steve mentioned using or contemplating a cross-border deal with a company based in the EU that already has an established presence internationally, almost as a stepping stone or a way to mitigate some of the risk in doing it alone. Is that something that you at Applied Materials have done before, or does that resonate with you at all?
Yeah, we tend to we're a mature company. We've been around since the 1960s. Our transactions tend to be with the developed world as opposed to the developing world. We do have a large operation in India, but really, we're more focused on areas like Japan and Taiwan and Korea and as well as Europe. I think altogether too often, the conversation when it comes to doing cross-border transactions does head straight to the brick, I think that may be really appropriate for infrastructure companies like Caterpillar or retail and consumer-based focused companies.
That's where the people are.
That's where the people are, right? And that's where where the middle classes are growing. But quite frankly, for us, being a more mature company and semiconductor focused, we're generally not nearly as focused on the brick in the developing world.
Yeah, I have to agree with that. We're talking about going to Europe first so you can go internationally. When we first started Priceline.com and we started to try and go outside the U.S., we perfectly honest, we did not do well. We had to pull back that effort. Instead, what we did in 2004 is we went out and we bought a company in the UK, and shortly after we bought one in Amsterdam and put those together. Those people had the experience of going out beyond their rather small markets and be able to have experience of moving out beyond that. And today, if you look at our 10K, 2013 10K, 94% of our operating income comes from those international acquisitions, which grew out throughout the world, which certainly I agree totally with you about that idea, that way to do it. The next thing that's very interesting is because we're in the internet. And the question is all of a sudden, well, what isn't cross-border? Because the internet is global. So if you have somebody who's buying something and they're located in Europe, well, European laws, do they apply or not? Even if the company is domiciled, let's say in Mexico. You have to be very careful, anything you're doing internet related now, that your actions may actually apply in many areas where you thought you weren't even doing business. But they think you're doing business there because they have a customer there. You have a customer there, he bought something there, their laws apply. So this just makes more complexity, things you always have to worry about. So we say, well, I'm going to go into India, I'm going to China. You may already be doing things in India or China if you're in the internet.
So you said more than 90% of your earnings are outside the U.S.?
94% of our operating income comes from the international acquisitions that we did.
It's amazing.
More than 80% of our revenue is outside the U.S.
Yeah.
What about Dover?
Well, so we're a laggard there. Part of the problem is we were a sleepy industrial domestic technology business for a long time. So our niche industrial manufacturing business probably we're laggards in terms of going global. So that was number one. Second, we have a pretty large energy equipment business, and that's essentially North American land-based, oil rig drilling-based. So it's growing so fast, we can't grow our international fast enough right now to keep up with our North American business. So we're about 55–60% North America still to this day. But our highest growing areas are absolutely internationally. There's no question. It's just we've got such a large, high growth North American business. It's been challenging to shift that mix.
And interesting mix there, guys. So one of the questions from the audience I thought I wanted to just touch upon for a minute here is about sourcing deals in some of these emerging markets or just on an international basis. So we're based in the States here. It's not terribly difficult to jump on the internet and find information on companies that are in geographies that look attractive to us for a variety of reasons. But do you rely on either a network of advisors, or do you have an internal team that helps you vet and basically circulate ideas to you to potentially pursue?
Well, now that we're a big company, it's a lot easier. A lot of stuff comes over the transom, multi-channel, lots of different ways people want to. We have a large amount of cash, and people, they see that cash, and they see what we do, and now all of a sudden people want to deal with us. Maybe 10 years ago, it wasn't quite a thing. In fact, a lot of people at one point thought we'd gone bankrupt and disappeared at one point. For me to get a meeting with some people sometimes is much more difficult, so it's become much easier. But you have to make sure you keep your eyes open. When I was early in this job running M&A for Priceline, and the CEO basically said, just make sure you field every single ground ball that comes your way. Just make sure you field it, take a look at it, see whether or not to throw it away. Because you can't be picky at that point. Now we can afford to be a little more picky.
Yeah, we don't quite have the benefit of your strong brand name because we're so diversified. Dover doesn't really go to market with that name. We're a whole group of different industrial businesses. Our way of finding those businesses is really, as I said before, strategy drives our M&A efforts. So it's a pretty granular look at who the competitors are, not only in North America and globally. It's more than an internet search, so we'll hire consultants if need be, identifying those players all the way down to on a regional basis, whether it's China or India, and then either getting advisors, and what we found is the local accountants are probably the best in some of these countries. The big investment bankers want to make the introductions, but the kind of deals we do, usually everybody has an accounting firm, and so we found some of the global accounting firms are pretty granular out in some of these regions. They go in these cities that we don't even go into. That and a combination of our identifying them based on our strategic landscape analysis, and that's really where we get most of our deal flow from, both domestically and internationally. And then I agree with you, just keeping your name, I'm in this industry and I'm a buyer, and making sure everybody knows about that, however you get that message out.
I think for us, regardless of where in the world the transactions are, I assume similar to Priceline and Dover, we have a very formal pipeline process where we track on a regular basis what the potential targets are, and we work very, very closely with the business development staff out in the divisions to identify and track targets over a long period of time. And what we really do is when we go through the discussion, we're really focused on how well do we understand what the inflections are in the marketplace, where are customers' roadmaps heading, what are we going to accomplish organically, and what are we going to accomplish inorganically. Then we look at the list and on a periodic basis, and what we really want to see from the list is making sure that the churn is there, that we're really turning over the targets. If they don't make sense for whatever reason, they can't pencil out on paper, or we don't have a willing seller, we try to make sure that we keep churning the list, and the list keeps changing. But of course, we need a very big opportunity set to accomplish close a very small number of transactions.
And a lot of times, something doesn't happen the first time you talk to somebody. I look at a deal we did with a company called Agoda. It's in Bangkok. I first started talking to the chief management group in 2000, maybe 2 or 3. We didn't do the deal until 2007. We had regular conversations. They weren't ready, and we certainly weren't ready at that time. But eventually, by maintaining that communication, at some point it is the right thing to do. So that's another thing, is make sure just because something's not right away, it may be right a few years later.
Yeah, we had an example. This is not a cross-border deal. Downhole rod pumps in the energy patch. Harbison Fisher, we acquired them about 2 or 3 years ago. The Fisher family has owned that for 40, 50 years, 2, 3 generations. I believe, this predates 2 or 3 CEOs. We've been talking to them for 17 years, and we finally got to buy the company from them. And even then, it was a competitive process, but you just have to keep that kind of continuity going over time.
So one of the things that I've read and heard recently is around the use of joint ventures as a potential deal type or construct that might help mitigate risk in dipping one's toes into the international waters. What's your experience been with JVs? Is this, Greg, you're already giving me a sarcastic smile. So I'm going to start with you. It's either going to
be good or bad.
Right.
Yeah. Why don't you get us kicked off here?
Look, I think the theory on joint ventures is interesting theory. I think any company that makes an investment, right? If you're going to make an investment in something, you're going to want to control the outcome, and that means I want to control the board, I want to control the management team, I want to have complete control of my investment to protect my investment, right, and to grow it. And so by that construct, you would think that joint ventures would happen, far less often than full-out acquisitions, right? So let's just start with that premise. Traditionally, I think joint ventures do occur when 2 people come together and someone has something that the other they're not willing to give up, right? And so traditionally it happens when someone has a product and the other person has money, and neither one can have the other, right?
Or one has market access and the other one has a product, and neither is willing to give it up, so they join forces somehow.
And so the difficulty when it comes, for people like us that do what we do for a living, the difficulty comes in, constructing that arrangement from the very beginning. So they're extremely difficult to put together. And when you're putting it together, you need to be focused on what the exit opportunity is. And because in the long term, it is very difficult to keep two different parties' interests aligned. And so quite frankly, over my career, I've probably unwound more than I've put together.
So it sounds like a great, for the lawyers and for spending time on paperwork, it almost doesn't seem like it's worth the trouble. Is that something that you've seen?
Yeah, I'd say that's sort of a perpetual business for lawyers. And I have to completely agree with Greg. And in the internet world, things change so rapidly. And whatever the alignment there was at the time you closed that deal, things change rather rapidly. And it will be a very short time between maybe you're not quite aligned anymore. And now what do you do? And that how you exit, that's always going to be a question of, well, if it's not working out, how are we going to exit? And you're going to spend a lot of time and energy trying to save it instead of just saying, it didn't work, let's get a divorce. It's not unlike a lot of marriages, actually. You spend too much energy and effort into something that's not working, and then you pull it apart.
It seems to me that on a cross-border basis, let's not to keep bringing up China, but they have certain protected industries, whether it's automobiles or something like that. For a U.S. manufacturer, if the only way you can get into that industry is via joint venture with a local player, then it's a go no-go decision. You're either not going to be in the market, or you're going to have a partner, a local partner. To me, we've never confronted a situation. We don't do joint ventures. We've either said we find somebody that we can buy, or we're just not going to go into that market. And we, luckily enough, have not been in any industries where we had to have a local partner. In the energy business, local service partners working on oil rigs, you do need relationship with some of the national oil companies. So there we've toyed with it a little bit, but that's more of a contractual arrangement.
And a lot of times you can think very carefully, is there a way to achieve the same result without having an actual investment? Can you come up with contractual agreements that achieve what you're trying to get done without getting into the minutia of actual equity, cross-equity ownership, or a JV structure, and things like that just add such complexity and don't do a lot to improving the operating numbers for the company.
Well, to that point, when we've thought about it with some of our larger businesses, you just say, well, who's going to consolidate that on their P&L? What is this really doing for me from a value contribution to my shareholders? It may make reasonable strategic sense if you're putting capital or a business in there, but we all live in a world where EPS and what are you dropping to the bottom line? So I think there's much more complexity around that too.
So we speak of some of the terms and conditions that have implications around how we think about these deals and how we bridge the gap. Sometimes it's valuation, sometimes it's otherwise. Earnouts, or contingent considerations, whatever. Let's talk about those. And I guess firstly up front, why don't we try and define what that actually means? Greg, maybe you can share. I know you've got some thoughts and opinions around.
Yeah. So I think the most traditional time that an earnout comes up is when you have a price gap, right? Yeah, so you've got a gap that you cannot close any other way other than with contingent consideration. And typically there's three ways to do it. One is revenue-based, two is an earnings-based, and three is a milestone-based, right? And so milestone-based have come up in our industry, and we've actually done one recently where you challenge the target to hit technology milestones. And my view is because really you want the most objective measure that you can find, all right? Because earnings-based are probably the most difficult because you're going to argue later about what costs get put in and how they get put in and what's allocated and not allocated.
Who's controlling the P&L.
Who's controlling the P&L. So I think if you go back and look at history, most often they're revenue-based, probably more than half of them are revenue-based, and then the rest is a mix of milestone and earnings-based. They're definitely tricky because, if you think we're going to use it as a retention mechanism for the management team, you can't really do that, because if you tie it to employment, the accounts are going to make you expense that in the P&L. And so it really has to be solely focused on the milestones in and of themselves. So that's first. Second, people also have to remember that it's not free, in your financial statements. You're going to hang this liability up in your P&L on whatever the fair market value of the consideration is going to be, and if there's any adjustment to that on a periodic basis, you're going to take that in your P&L. And then I think, the other thing that I would say is when you negotiate it and, and it comes time to closing, your attorneys, if you have good attorneys, would tell you don't negotiate something that you wouldn't expect to pay. So the attorneys would like you to view it as, hey, if I'm going to agree to a $20 million earnout or a $50 million earnout, I should be willing to pay 20 or 50 million. It's not like we're trying to escape, some level of purchase price here. We should be fully expecting to pay, the full amount. And it's because those people are going to be your employees as well. And so, they're going to have firsthand knowledge of how much focus is going to be put on the business after closing, how much investment is going to be put into the business after closing. And so, if they don't make the
look at the motivational aspect.
Yeah, look at the motivational aspect.
Where
if you don't pay them.
Yeah, the first year they're way behind, and they're saying, "Well, I'm never going to see this." What kind of motivation is that?
Right, it's tricky in terms of aligning it. I mean, you have to set the expectation that you will. And Glenn, I know you've had some experience in structuring these, and curious as to what your overall takeaways are, and whether you're, I guess, relatively in favor of them or not.
Well, every international deal we've done with the private company has had a substantial back-end potential for the management founders. So this is an important thing. These companies that we've done these deals with, Agoda, Booking.com, Active Hotels, what was called, it's now called rentalcars.com. In all these things, the founders were still in charge, still working hard, and when we came to do a deal, they were still enthusiastic about doing it. And it's sometimes hard for a founder to say, I'm going to give up control. And because I think I still have a lot of upside left, and I want to. So you have to work a structure, and we've had many different ways to do it with these management groups in a way that will give them the incentive they need, the flexibility to try and achieve what they want to achieve, but recognize in the end you are giving up control to us. And it's worked out perfectly every time. Some people say, when you sign anything that has an earnout, you're also, go get your lawyer now because you're going to be in a courthouse in 3 years. We have been very fortunate, knock on wood, it hasn't happened to us yet, and everybody has been very, very happy, but I recognize that many times it doesn't work out quite so well.
Is that because you've paid them all out 100%?
No, not everybody's been paid out 100%, but some of them, I mean, the top end was, you're getting into the stratosphere, and what they did get will allow them to live happily ever after.
So typically they're capped, and so what?
No, we've had several that weren't capped at all, and in addition,
so they get to share a significant
totally, and even more so was, and we made it very clear, and you made a great point, Greg, about wanting, when you sign it, be willing to pay it. Yeah. We are very, very verbal about, we hope we can pay you as much money as possible. And you know something? We paid more than we ever thought we ever would, and we were thrilled to be able to do it.
So it sounds like it's a very much of a motivational tool for you guys.
It's motivational for everyone. It also enables them to still feel that they're still running it, in control of it. It gives them, it's not just the money. It's a sense, in 2 of the deals, I think offhand, or was it 3, they had a minority stake. They still owned equity in what actually was the holding company above their company that we created, that we shoved it into. So they felt, okay, I'm still an owner, I still own equity, I don't own as much as I used to own, but I still own it, and they got paid out 3 years later, and we've determined what's the fair market value of that company down the road.
When you look at your ultimate payouts, what percentage of the initial purchase price is the payout?
Well, again, it depends, but
100%?
in all of the ones that I'm thinking off the top of my head, the payouts were multiples of the initial consideration to those people, to those founder management guys. They only owned 20% at first, then they ended up, they gave up 10%, they owned 10%. They did a heck of a lot better at the back end than they did at the beginning. And by the way, each one builds on its own. When I did that first deal with Active Hotels and trying to sell them, just trust me, it'll all work out fine. They said, well, can you speak to some of the people you've done it with before? Well, actually, no, I can't do that because there isn't anybody to talk to yet. But now, because they've all worked out so well, when I go to somebody and tell them, look, here's the structure we're thinking about, I say, here are the names and telephone numbers and emails. You can talk to anybody who is part of this thing. Some of them don't work for us anymore, so they're going to say whatever they want to say. Go ahead. let me know how it
Do
comes
you
out.
think those would work as well? You're in a pretty high growth market.
Yes.
So do you think they would work as well in an industry that's growing 3, 4, 5% a year, and you're fighting over whether you're going to grow 5% or 7%? It seems to me the attraction or the motivational incentive of such a high growth industry makes it much more of a
You very well could be right, but on the other hand, though, they have very high targets because when we buy it, these multiples, to get that value to go up, they got to maintain that very high growth rate too.
I think it's a good point because I think earnouts most often occur in life sciences businesses, high tech.
We were talking about some
where you
incredible
have
high
steep
growth
growth.
rates, yeah.
People have really different expectations on value, and that's where they come out.
Yeah.
So absent earnouts, we talked about motivation, and obviously attrition is a troublesome thing in any M&A scenario, never mind if it's cross-border or not. But how do you ensure, especially when these can be life-changing deals, even at some lower valuations, how do you ensure that the management team is motivated and that retention is something that can be managed?
Yeah, I think for us, we've dealt with this issue on every single transaction that we have. Some situations more than others where the management team, may have a significant amount of equity and seek and gain a significant amount because of the transaction, and so trying to keep those people motivated as they transition into the company is a really difficult exercise, and so traditionally the thing to do is to kind of hold it back from them, pay it out over time, and make it richer, right? Whatever the expected payout was to them.
So just a deferred.
Yeah, right.
Deferred.
Right.
Okay.
And you have to get them to agree to it because they're entitled to it. The fact is they're entitled to it day one. But the fact of the matter is, I think you need a very strong retention plan, whatever the plan is, for management going into the transaction. Otherwise, if you're going to lose the entire management team day one, you should really, really question whether or not the transaction makes sense. And so we really focus on this, during our diligence review process.
So I think we've got time for one more question here, and it's going to be sort of a big one. But valuations right now, let's close with this topic. Prices are high. We know that. That's impacting cross-border, but that's also impacting all of the domestic transactions that are being evaluated and being announced right now. So, how do we navigate and manage and make sense of this valuation environment that we're living in right now? And does it have any specific ramifications to evaluating cross-border deals?
To me, timing and valuation is a fascinating subject. I think when you had the bottom of the economic cycle, and March of 2009 was the bottom of the stock market, right? And if so, the people that are selling at that point in time, if you don't have to sell, you're not going to sell, and because it would be very difficult for a management team to stand up in front of the board and say, now is the right time to sell, right? Because asset values are very, very low. But now, as in a multi-year growth cycle, where asset values are high, you do have a lot of willing sellers, and so it does make for a very healthy M&A environment. I think deal flow and in terms of transactions and values are very, very high, and so this is a really, really good time to do transactions. How long this lasts, as asset values continue to rise, more than their historical averages, is a difficult question.
It's hard though. The same way you say somebody doesn't want to sell at the bottom of the cycle. The problem also on the buy side too. You're afraid to buy sometimes because you think things are going to get even worse.
Right.
And it'd be interesting. I haven't seen the numbers, so it'd be interesting what percentage of share repurchase was done on the outstanding stock in 2008 and 2009, right, when people they knew their own company well.
The track record's pretty bad on share
I think it is.
The point about the bottom of the cycle and the lack of willing sellers, it is all about seller capitulation, right? You can't get seller capitulation in a transaction at the bottom of a market. Now you have all kinds of willing sellers and willing to do deals. That makes it a much more liquid environment.
Then I get afraid that way when all of a sudden people are coming wanting to sell. Why do you want to sell?
Valuation is, we could be talking about this for a whole nother hour.
We've got about 30 seconds.
Right.
So,
If you could answer the question that there's going to be a global excess liquidity of capital, so we all have a lot of liquidity on all our respective balance sheets. We don't have to go to the debt markets. And long-term low interest rates at 3-4% that we could borrow for the next 20 years, I'd say valuations probably aren't that bad. But we're all sitting here saying, we're not sure how sustainable that is. Interest rates may go up. Liquidity may be a little bit tighter. So I think that's why we're all looking at today's valuations and say, boy, they look really expensive, because we come from an environment where you can't borrow as much money as you want at 3-4%, and there isn't just a global glut of capital. So the other thing is, there are consolidating industries, and the market is rewarding people who are building global franchises. So you look at some of the larger transactions in your space or my space, there are only so many strategic assets that go around. And when they're available and when they're gone, you have to make a decision on valuation.
That's right.
Excellent. So I think that's all the time we have for today, gentlemen, but thank you so much for joining us today and for the lively discussion and insights. I hope you enjoyed it as well, and thanks for watching.